Commoditization of the asset management industry. This too is a big thing. We've touched upon it. ETFs, the rise of ETFs. Those are set to double as a percentage of global AUM, up to about something like 22% of total assets will be in ETFs by 2020. So that's a major change. I think you're finding in the asset management world in general that they're squeezed now. Most mainstream asset managers are squeezed between a rock and a hard place. They've got the ETF business nibbling away at their traditional active management side, which is charging too much for too little in terms of its alpha generation. And then you've got the hedge funds at the other end nibbling away at the alpha generation side. And you've got the mainstream asset management business stuck in the middle. They're too big for what they do. They cannot develop net of their fees a performance that beats the index. That's proven year after year after year after year. And they're charging too much for it. So the asset management industry really has to have a look at itself and decide whether it's going to be marketing-led, whether it's going to be an asset gatherer, in which case it's almost certainly going to move into the passive world, or if it's going to be performance-driven, in which case it probably needs to slim itself down and focus on a smaller number of more highly concentrated investment products. So I think the mainstream asset management industry faces a real transformational issue in terms of the way that it redraws its business going forward. And it really hasn't faced up to that. If you still look at the adverts on the buses and things, it's still, it's still all about performance. And the one thing we do know about performance is not sustainable. It comes and it goes. And what you need to be doing if you're an asset management executive is to be focusing on the things that you can make sure are consistent year after year after year after year, which are things about the brand promise. Are you an ethical business, for instance? Do you serve your customers properly? Do you charge an appropriate price for the products that you offer your customers? Are those products always delivered to your clients when they need them, or are you selling them what you think you can sell them because it's the latest go-go product that you're offering them? And none of that is, at the moment, when you look at the way that asset management businesses hold themselves out, is in any way part of their promise to you as an investor. What they're really sort of trying to compete on is their performance in relation to their peer group's performance. And that's a real problem because, as I say, it comes and it goes. And as far as the general public is concerned, it's very hard to identify asset management companies that have really been able to distinguish themselves from their peer group. And as a result from that, it's not surprising that the distributors mainly are in control of the way that those products are distributed. My final point is that the social pact between asset managers and the industry is beginning to change. I think we see that evidence everywhere. Prime Minister Li Keqiang in China has declared war on pollution. More and more society expects our industry to be playing a role in the development of society as a whole and in transitioning capital to where it needs to be. The rise of Sharia funds, the rise of ESG funds, I think, are all evidence of that trend. So those sorts of things are really extremely key as well. So to summarize, I'm running out of time. I think all I would like to say is that we can all contribute to the future. Trust is absolutely key. We have to put our investor interests above our own. We have to think a little bit more deeply about what the fund management company of tomorrow is really going to look like. What is its purpose in terms of not just society, but in terms of the way that it fits in to this transformatory landscape. And we must help our professionals gain a clearer understanding of those responsibilities. But I think together we can make sure that out of this transformatory landscape, we build a better fund management industry and a better financial services industry to serve the public's needs going forward. Thank you very much.
Well, thank you, Paul, for the very insightful talk. Maybe we can take a few questions from the floor. Anyone have any questions? Yes? Excuse me. Yeah.
Hello, can you hear me?
Yep.
Daniel Shane from Asia Asset Management magazine. There was an interesting point that you made about in the future the most interesting jobs for asset managers will be with sovereign wealth funds. I was wondering, do you see a point in time when these kinds of big institutions don't need to rely on external fund managers at all, when they can just hire all this best talent in-house and skip on using external fund managers entirely?
I think it's a great question. I think it's happening already. Most of the big sovereign wealth, CIC, for instance, which obviously is the granddaddy in this part of the world, and the GIC in Singapore, already have their own in-house investment teams and dealing teams as well, their own corporate governance teams. They have more resource available to them than an asset manager here would have. If you think that that the largest asset manager in Asia in terms of Asian sourced assets probably has about 70 to 80 billion US dollars being run out of Asia. Sovereign wealth fund like the CIC is very competitive as far as that scale is concerned. And the largest asset management company, really, when you strip it all away, probably has no more than 120, 130 frontline professionals. The sovereign wealth funds have many, many more times that. The larger ones have many, many more times that in terms of their, I think GIC has something like 450 investment professionals. So they're already probably 3 times the size in terms of their investment staff of the largest asset management company here in Asia. Now, whether that means that they're going to do a better job or not is another matter, because obviously it's a question of the quality of people, and sovereign wealth funds are quasi-governmental, so they don't necessarily pay as well as the private sector does. But I think if you think that the private sector's fee model is under intense pressure at the moment, you're going to see that I think that the migration of people, of quality people from the private sector into the state sector, for want of a better phrase, will definitely be a trend for the foreseeable future. The only way you can break out of that, obviously, because you don't want to go into ETFs, because that's a computer as opposed to an individual. So where do you go as a CFA, for instance? You probably go into a sovereign wealth fund, a private equity fund, or a hedge fund. I mean, if you're looking for active management, the challenge with sovereign wealth funds is that they are so large. How much active management can they really do?
Okay. Also, just quickly, you mentioned about a Chinese asset manager potentially buying a Western asset manager at some point in future. Is there any targets? Anyone you can name?
I wish I was that well plugged in. No, none that I know of. None that I know of. But it's a dream of mine to wake up. I mean, I work for an American institution. There is nothing that would give me greater pleasure as an Englishman than waking up one day and finding that an iconic American asset management company had been bought by the Chinese. It would amuse me hugely, because my American colleagues absolutely refuse to countenance that could possibly ever happen. It's very interesting.
Would the American regulators allow it, though, do you think?
Yeah, I don't see why not. I mean, obviously, they're going through the states at the moment, this thing about whether asset management companies are systemically relevant or not, and you whichever side of that coin you want to be on. But I don't think they really are in the main, or most of them aren't. So I don't see that it would have that much regulatory challenge.
Yeah, thank you.
You talking about the disappearing investor, basically.
Yeah.
Base investor. Now, what about retirement? You're also talking about, we're getting older. And what do you see the future for the retirement structure? If I'm an industry?
In terms of the structure or the investment side?
Yeah, the investment side.
Right.
I mean, clearly you say that Asian people do not save properly. No.
But they invest into insurance products, perhaps rather more than they should. And I think it's the insurance companies that are actually providing the products that most Asian retirees will have in their back pockets when that day comes. I think the household balance sheet is basically something like 60% cash, 5 or 6% mutual funds, 15 to 20% pension funds, and then 15 to 20% insurance funds. And the pension funds in the main, particularly in this town, for instance, are actually wrapped through the insurance companies. I mean, the HSBC life insurance business, Manulife's insurance business, for instance, dominate the pension fund provision. So it's the insurance companies that are developing income-generating products, basically, for that retirement market. And if you look at the things that they're selling at the moment, you can see that they're either fixed income related or they are, in some cases, capital stripping for income as well. So that is becoming a big business for those types of insurance companies. They're all figuring out ways of launching, whether it's high dividend yielding equity funds or other types of products, ways of developing somewhere between 5 and 10% annualized income for their aging investor base. So again, it's quite a negative thing in that obviously that's money that's going to get spent and isn't going to come back into the AUM of those asset management businesses as it's drawn down on.
So maybe one final question. So yes.
Hello. And you just said about the China-Hong Kong mutual recognition scheme. You said that China would like to look into the competitiveness of their product in the field of the global perspective. So do you think right now the recognition scheme is still developing? So do you think right now the major hurdle is from the China side rather than Hong Kong?
Actually, I would probably guess it's the other way round. I think the Hong Kong SFC, I don't know, but I would imagine that when they're looking at the equivalent standard of investor protection in China to the regulatory regime that exists here in Hong Kong, I imagine that's what's giving pause for some thought at the moment, whether they're happy with the way that Chinese regulated products are constructed for sale to retail investors here in Hong Kong. That would be my sense rather than the other way around. And I don't think it's a product issue, by the way, sorry, just to sort of make the point. I think it's more about Chinese asset management companies seeing whether they have the staff to be able to develop product, to be able to manage money competitively in the international world.
So with that, I would like to wrap up this section by thanking maybe Professor Bunoswani can help us with a presentation of a token of appreciation. So a big round of applause.
Thank you. Thank you very much. This is lovely.
Thank you.
So thank you very much for the CFA Institute. As a preview, next month we will have another seminar. We have invited the Chief Rep of IMF in Hong Kong, Sean Roche. He's coming to us and we'll talk about the Global Finance Stability Report. So what I heard is he's kind of like consulting to the Hong Kong government, and this is something of maybe the later half of a financial forecast on US, Europe, and Japan that he presents to the government. So if you are interested, stay tuned and we'll send out the invitation soon. So thank you very much, Dave.